Hello guys, glad to have you on board again today. I'm pretty sorry about the delay today. The review might be shared a little bit later than the usual time scale. And we're also going to make a shorter video. Yesterday's 1 hour long one was a little bit too much, and today I don't have that luxury. So we're going to move on, and first I'm going to give you a tip that I just discovered, because for some reasons I've been wrong, thinking that sine wave was out of synchronization when it was down to trading altcoin versus Bitcoin. Because for example, as you can have a look, if this is what I've been having a look at, and as you can see, sine wave is just absolutely lost in here and just can't figure out anything to do, and as you can see, the oscillator is also responding pretty much differently, and I think I've just figured out what the problem was. Is the actual price level that we have in here. We don't have enough. As you can see, it's stopping to price at some point, and it's kind of a danger, and changing it is possible by just adding a multiplier to that level. For example, if you set multiplied by 1,000,000, you get to actually restore some sine wave cycles. So I've just discovered this, and apparently you can use the indicators on altcoin versus Bitcoin right now, and it should be fine, but you need to make sure to do this first. I'm going to publish, to add this to the future, to the next update regarding sine wave beta, and I should eventually push a release somehow, some way, just to automatically adjust this. But in the meantime, I recommend you guys to just do this. So if you want to study an altcoin versus Bitcoin, this is now possible, and I've been wrong thinking it wasn't. It was just a problem about the valuations, the pricings, the prices themselves. So by just adding a multiplier to restore them to normal values, you are having something that is working just fine. So do it that way, and sine wave is finding the synchronization when you're doing this. So I wanted to start that video with sharing that tip first. So now moving on and just restoring what we're usually doing regarding the Bitcoin into a daily chart time frame first. The momentum has finally pulled out of the overbought area. We're on a bearish oscillation in momentum. We've been making daily candle closes below the previous day low, so we are in a pullback situation in here. Question now is how long this will last until we manage to find a support area. This is something that is pretty much hard to tell. So in terms of a daily chart time frame, if we're having a look just at the volume, we've got a breakout in here possible near 7,800. So it's either we're going to break below that level, and then the range will be filling that area, and we're going to have support there, resistance there, until we manage to get out. Second option is that this will be the bottom of a range, and in that case we're going to oscillate higher, probably targeting the 8,700 as expected by the previous scenario. So we're just into the same usual things in here. It's just waiting to have the release. I think buying right now is a little bit aggressive, but for some reasons, actually right now the altcoins might be the one who could be about to save the Bitcoin. So if for some reasons we could have an altcoin pump, that could allow the Bitcoin to hold that support. Option number 2, we've got a bearish breakdown, and I think the altcoins will be suffering from this one more time, but not necessarily going to be the end of the world for those. We'll see about that. So it's kind of a wait-and-see approach in here. We are near a technical breakdown support, which means to me 7,800 is nothing I want to buy, but to be honest, we have a clear double signal in here. We've got the target, we're still above this, we've got the blue triangle confirmed by a bullish momentum, so normally you should be a buyer of Bitcoin right now. I'm just not buying it because I think the altcoins could be producing much more gains, as the next target for us is just heading toward 8,700 or 9,000, which is just 10 to 12% burst, where I think IOTA, for example, could just get there and make a 25 to 30% upward move. So I'd rather like to take a little bit more risks, putting money into the altcoins instead of the Bitcoins, even though the trend is obviously on the opposite side right now. It means that the money is flowing into Bitcoin from altcoins, and we'll see about that. But I think right now I'd rather like to trade that kind of trendy and trying to figure out what the next move is, and not just playing the ongoing move. So that's how it is. I could be right, I could be wrong. Once again, I don't have a damn clue. All I know is that I'm ready to buy. Now, just to be fully transparent with you guys, I've been making a mistake yesterday regarding the Ripple. I said I would buy Ripple upon breakout only, and that I needed to have that price broken up to trigger the bullish entry, and I've been doing a stupid mistake. I thought by placing a buying order above the current market prices, it will automatically set BUSD to set a stop entry market order. It wasn't the case. I was executed right at the market price. So unfortunately, I've been buying that fucking damn resistance, which is something I generally never ever do. You've never seen me buying a resistance. But as a mistake, I've been doing this. But to be straight, I've just been putting 500 euros in there. So this is nothing that I get too concerned about. It's just that if I get to be stopped out, it's going to cost me a stupid $100 for nothing, just because I've been making a mistake. So it's not going to be the big of a deal. It's clearly nothing to me to lose $100, but I would have rather liked avoided that mistake and traded the breakout rather than paying for that damn resistance. So we'll see about that. Obviously, the market has retraced downward, in which I think the current prices might be interesting to buy to those who would like to buy aggressively. We are now having a bullish momentum, and I think sine wave is about to reverse as well to a bullish cycle, or brutally reversing here. As you can see, this is a weak bearish cycle, so I'm waiting for the breakout to occur. And having that pullback could be the right sign if for some reason we were to make a big, nice, beautiful candle. So this is what I expect right now, having some kind of bullish pump into the entire altcoin sector. That would also obviously work on the bullish side to the Bitcoin as well, but normally the Bitcoin should be far less profitable right now than the altcoins could be. The second big day thing we need to talk about is this. We're about to have the GDP of Q2, which the market expects to literally double. I mean, like, the market is just going to unicorns right now. Nothing has changed in the economy, yet we do having some nice release in terms of earnings and things like that. But what the fuck? Are we really going to double GDP? I don't think so. So we'll see about that. If for some reasons we were to fail the consensus and getting an actual 4% annualized GDP, then good for the dollar. It's going to fucking pump. But I don't think that's going to be the case. So we'll see about that. It's a catalyst. I don't know what the market will be. I don't know what the number will be. I don't know how the market will react to this. But all I know is that's really a big number. And I don't think that the U.S. economy is nearly close to make 4% annually. GDP, we are more likely to be near 3%, and that would even be a big number anyway. So we'll see about that. I mean, that's today's catalyst. We're also having some price index, so it's interesting to see how the thing will be today. But to be honest, I don't know how the fuck analysts have been managing to put out that 4% annualized return. It's nothing close to be this, but we'll see. If this is actually the number, then the dollar is certainly going to pump and hard. So we'll see about that, but I don't think that's going to be the case. We also have got Amazon returns into the that was mixed returns, so we won't go crazy high forever, even though I've been taking Twitter as an example. So I'm just going to show you this. If you take Twitter, so I'm using TweetDeck to have a clean look at this. So let me just showing this for a couple seconds. So I've been getting in there, making a search for Amazon. Okay, I'm going to show you. Rise to $230, Deutsche Bank. Everyone is bullish. It's bullish forever. You'll see a lot of comments about stupid prices. Amazon's forecast, strong fall sales. It's nothing close to strong. I mean, we haven't failed the consensus. What the fuck's going wrong? It's like everyone is overpricing things. It's just good. It's fire and lightning. We're going to go on forever. Silicon Valley, whatever. So we've got emotion and stupid traders. It's just emotional trading. Yes, are you owner or donor? You should get to buy Apple, McDonald's, Starbucks, Nike, just buy the whole American thing. So that's what's at stake right now, purely the example of a bubble ongoing. All the analysts trying to forecast long-term scenarios where we are trading in a short-term perspective with a bubble. So as usual, always the same mistakes. You see all the analysts bullish, just doing their job. They are trying to forecast what's already in play, knowing that this is not going to last forever, but they are forecasting 12 months ahead, as we cannot even see what's going to happen in the next quarter. So this is just a stupid analysis as usual, but analysts are just doing their jobs like they're supposed to do. I mean, we never ever follow an analyst until we are into a growth period, which we're clearly not. So don't follow the analyst right now. It's the best way to lose your money into the next recession. You better have to follow the traders at that stage, and traders are trading short, or they are trying to short the market slowly and patiently by tiny leverages, trying to find the tipping points. But believe me, I've been talking about my colleagues out in New York, speculators like me. They're all trading short. They all know this is short-term trading, anyway, we can suffer for a couple more months or a couple more quarters, but just as I said, they all think that we're not going to last till the end of that year, and that if we do, it has to be at the extensive price of even more distortions, which means we'll have to have a really big and solid dollar, and we're going to have a crazy rising yields. Means the only solution for the S&P 500 to hold the highest prices until 31st of December is to have rates rising at a very slow pace and having yields nearly at 3.6 to 3.7%, which is obviously going to trigger the credit bubble at any time, because real estate credit buyers won't be able to pay for their credit anymore. So it's just danger all around the corners. So anyway, it's not going to end well. It's just short-term perspective. We'll have multiple scenarios, and once again, these are scenarios I've been forecasting for quite an extended period of time. If Wall Street obviously wants to have the market top of the S&P 500 right now, that's the only thing that's in the trader's mouth. When are we eventually going to reach out there? So it's just not if, it's when. They don't even care about the price. It's no longer about that. It's just about how long can we keep this ongoing and get to the new market tops, so we can make headlines. And then if we fuck up the economy to do this in the meantime, that's not a problem. All we care about is just going there. And when you see this, it's because of the market trading, because of its previous states only, and that's a psychological effect that is typical of ending cycles. So I just keep on doing what I do. It means that I will be searching slowly for the market top to occur, and the bulls to be obviously wrong-footed. There are got multiple options, and I'm going to show you those. First option to me is to have the market just picking slowly, just as Wall Street will like it to be. They like to reach out to the market top. Just keep on following the ongoing trend. Actually, you can see we should be following the bullish trend, just following that channel, that slow grinding channel. It's just everything's doing fine. The VIX is low, so we're doing well. We're not going faster. We'll just keep on following the same pace. We'll be just right to get to the market top, and just keep on pushing and trying to keep up the bears as long as possible, trying to find some sideways action until we manage to break the lows. That will be a fake signal first. It's always the case with Wall Street, just trying to fuck up the bears who will be too aggressive. Then we'll make a new high, and this one is going to be the end, and then we're going to fall apart. It's just basically what we've done every time at Wall Street. Having a look at the weekly chart, you'll see what I mean. Yes, this is exactly this. Slow grinding move, but whenever you have this, you've got visibility. It means the market is slowly letting you know that things will be dirty afterwards, and that you'll take the time to get out I don't think that we're nearly close to do it, but that's what Wall Street would like to have. They clearly want to tell you this. They want you to think things will be great and you'll have visibility and it will be fine. You'll have time to get out with your equities. You'll have pre-signals and everything will be just fine. Guess what? This is what we call wave 3 termination, because this is when the trend is still ongoing. We're wave 5, which means we're going to retrace like that, and it's not going to give any signs of pre-signals. So we've got that risk, the risk of putting out a bubble on the S&P 500 and reaching out to, for example, 3,000, eventually going even higher than that. It's just creativity is the only limit at that point if we're going to go creating a bubble. But afterwards, you know how it's going to end. It's not going to be pretty, and we're going to pay even more in the end if we play that dangerous game. And option number 3 is obviously the market just going slightly higher, failing and fucking all the balls in the same row, which I think is the most probable right now. And this is what I'm trying to trade. So I'm patiently waiting to have some brutal reversal, unexpected, everybody triggering the stop losses in the same time, and all the balls being obviously wrong-footed in that scenario. But let's set things straight. We should be, in that case, into a bullish perspective, which means we need to have 5 impulses. And as you can count them down, right now we only have 1, 2, 3, 4, 1, 2, 3, 4, 5, 6, 7. So it's not good. Okay, it's 1, 2, 3, 4 market tops, and I want to have 1 more. Okay, it's not working well. It's 1, 2, 3, 4, 5, 6, 7. Sorry, what the hell's wrong with me? 1, 2, 3, 4, 5, 6, 7. Normally it should be 8. No, okay. So what we're having in here is 7 is generally not a wave count that is triggering a bearish reversal. We'll have to wait for 9. I mean, to me, it requires 1 more market top. We need to make 1, 2, 3, 4, and 5 market top to get there. It's either 3 or 5 or 7 market tops new highs in a trend. As if we were in trend means that I will have been wrong about my my range context, but that doesn't mean I'm wrong in the end. It's just that I have to switch my scenario. What I was trading back then in here was the fact that the market could be in range mode and just going to make an extended wave 5 before making extended wave 4 before making the wave 5. And in my perspective, this is what we would have done. A big, nice and profound wave 4, but not that big of a deal before having a bullish 2009. What we're doing right now is just wasting our time by getting too fast too high. And as we're doing it, I mean, if Wall Street is heading toward the market top, to me, that's not a good sign. Not even to say that's the worst sign ever. It means that we won't last till 2019 because it will require this to make this a new wave in here, a bounce, a final wave, and then the end. So that's it. That's what's at stake, what's at play. So we're going to try grinding in here as long as possible. We're going to try hanging there for as long as possible and never ever breaking the market top. We're just going to try making multiple pullbacks, anytime trying to grind slightly higher until the moment we're going to retrace to the downside, making 1 more final push for the DOMs to trigger stop losses in here, and then we're going to collapse. Okay? So this is how it is. And I think that's the most probable scenario. That's the unexpected scenario, but that will require market catalyst. So we obviously need to have something showing up in between, some kind of black swan. Otherwise, this is what Wall Street will try to play. So I think without problems, this is what we can expect. And of course, the timing can be variable. It can last for long, but I think we need to have 1 more pullback inside the trend channel. And just to set things straight, this is what I expect. You can take that trend channel, take the 2 previous lows as always. We're going to keep on going with the same trend. you just do this. I think this is what we'll do. We'll try grinding our way higher. Never ever get to below 50% of that channel. We'll stick to the bullish part just to have optimism. Never ever pessimism. It's not possible. This is where we'll get pessimism. We'll just will be a pullback. We'll just grind our way up once again. Everyone will tell you that this is bullish and that we're going to go parabolic. You will have to know that this is where you take the big short. And now I'm not talking about a corrective, okay? I'm talking about the fucking big short, the one you want to take and hold for months. So this is where the big short is supposed to be if everything plays by the rule. I mean, if nothing goes wrong, and if for some reasons you've got a bearish market catalyst, unexpected catalyst, don't know what, but I've told you, we've been piling up risks at a very dangerous pace, which means anytime something can go wrong and the market can just over-collapse afterwards just because we've been piling too many risks. And it just requires a 10% drop on the equities to just flush the entire bubble, credit bubble, okay? It's a mechanism. I mean, it's like right now we've been taking extensive amount of risks looking at the junk bonds. I mean, it's like investors have been buying fucking junk bonds right now, which is the obviously worst choice ever. We're pre-recession, so buying junk bonds is the worst possible choice you could make as an investor, which means investors are greedy as hell, and this is danger at that point. If they're taking that amount of risks, means that anything that goes wrong can make the entire thing collapsing. So just be aware of this. Right now, for example, this is something all the asset managers are looking at, is the fact that whenever the junk yields, it's what we call the junk yield spread. It's the spread you'll have between the junk yielding and the graded bond yieldings for corporates. Okay, we're talking just about corporate bonds in here, and right now we're having a spread of 1.7%, which means that the average yields on junk bonds is just yielding 1.7% higher than the highest grade of percent yielding, which is absolutely nonsense. I mean, you're taking huge amount of risk by buying that by lending money to junk companies, and it's just yielding 1.7% average price, average return in the end. So extensive amount of risk for no reward, which means crazy high risk taking, nothing close to investment strategy, is just heavy speculation. And when you speculate out of a market top, generally means that the market top is clearly near. So Wall Street wants to make you think that this crazy bubble is about to take place. That's what all the investors would like to, but they are taking heavy amounts of risks to see this. And if it's not the case, and if for some reasons the junk bonds get back to support once again, believe me, it's not going to be pretty, because lots, it's going to be billions of dollars that are going to be lost. Basically means that the lending to junk corporates will be even worse than it was before. It means that they'll not be able to lend money, which means they're going to have to lose money. They'll have a negative cash flow and not be able to lend money to pay for the bills, which means that they'll have to foreclose. And whenever they will do it, it means that the supply chain will just fall apart, which means that the entire economy slowly will afterwards. This is the first dominoes of a very dangerous situations that we have already been playing. So only professionals right now know that things are not going to be pretty in the next following 6 to 18 months. Okay, let's say 1 to 3 semesters. Obviously things will be dirty at that point, and yet we're still having analysts making 12 to 24 months forecasts just to sell you very expensive shit like Amazon. I mean, it's like, have a look at Amazon and what the analysts are doing. What they're doing is they're forecasting the EPS so EPR, the profit ratios, we don't have them. I mean, what the hell? I'd like to have those in details. Its financial profile, maybe not. Maybe this. No, I'd like to have specific. I'm going to pause that. Yes, this is where we got the PE ratio. It's just dropped down to 164 after being at 300. So that's good. We've been nearly dividing it by 2, which means okay, investors have been buying it the last quarter, have been making a right choice, but at some point it's going to be the opposite. Okay, and I think that's about to come within the next quarters, and that's a good example. I mean, we're buying stocks at a fucking historical expensive price, and at some point it's not gonna last forever, and anytime we're gonna get it, I think that's what I forecast. I think we can very much last until October, and October is going to be the next bearish timing. I mean, consider this as historical price patterns through time, and generally you've got a bearish timing throughout the summer, which just been flushing that pattern entirely, and this is why Wall Street is just thinking that we're going to have a pretty bullish end of that year. I mean, this is what I've been seeing in here on the VIX. Yes, Wall Street's sleepy summer could be setting up the next stage for stocks bull run. It's like the end of the year is going to be quite tranquil. It's going to be fine. Everything's going to be great. VIX will remain below 14, 15. We're going to get into nice and sweet visibility until things implode. So this is what Wall Street thinking right now, that this is going to last forever, and that we don't want to think about things that could go wrong. We want to think only about what's bright, what's nice, and what is going to provide gains. So do it that way, but be sure that nothing is going to flush the party out, because be aware that we've been piling up risks. So the problem, I think, with Wall Street right now, and I'm going to sum it into a single sentence, is the fact that Wall Street think that we're going to replay this. But just to set things straight, this is what we have when we're terminating a week 3, which means there is no fear for recessions in here, where I remind being trading this, everyone was just fucking panicking back then, saying, oh shit, the Wall Street's falling apart, we're nearly reaching another crash. I was buying those lows, eyes closed. Okay, so there was no fear for a recession in here because we were in the growth trend, in the growth sector of the trend. I've been making a video to you about this. This is what we call smart investment. This is what we call growth, cycle growth. This is where the entire economy is profiting. All the companies are profiting. Everything is just fine. There's nothing to worry about in here. It really is the blue sky. This is where you can create trends, and this is where you can value stocks without the damn sense of risks. So it's normal to have no sellers, and it's normal to have rounding top structures at that point because there are no risks. We've got visibility for months ahead and years ahead, and even if we have some pullbacks, we know that years ahead we're going to be higher, which means we don't have to worry about stock pricing. Now you should worry, because what's coming next is that we'll have negative return for the next years, probably. Of course, there's no certainty once again. I might sound like a certainty when I say it. Once again, I'm a speculator, so just take me as I am. I'm just speculating, so don't take my words for granted. I'm nothing close like a visionary. So what we're having right now is the danger to be negatively returned into the 24 next month. So you should worry about a recession, and now you should worry that this is obviously not what the market should look like. Could be the case, but generally this is not what we're having at the end of economic cycles, because this is what we price when we've got a credit bubble, means the risks are piling up, and at some point the credit bubble is exploding. So it's risk, making fucking losses, and credit bubble exploding. This is what we have into speculative bubbles. As you can see, this wasn't the big of a speculative bubble in 2000s, but if you take the NASDAQ, you'll see a pretty much different picture. This is what happens when you have speculative bubbles, crashing, dead cat bounce, and falling apart markets. So we're going to have a mix between those two. We've been creating a bubble. We shouldn't have done that, so you can expect the Nasdaq to just fall apart, just like it done back in 2000. So the Nasdaq will crash at some point. Can be tomorrow, can be in a few damn months. We can have a crazy, stupid move to the Nasdaqs just to terminate a speculative bubble. But to me, it's already mature. We've already had the volume pullback, the volatility, which means we're in a final wave. It can last for a few months, but I don't really care. We're about to burst anyway with the Nasdaq. So it's just a matter of time right now. But you should be worried that what we're expecting is nothing close to what we had in 2015. So those who are trying to sell you tranquility, they are making a huge mistake. And those who are selling the VIX, they are really playing a dangerous game, because if anything goes wrong, the actual difference between 2015 and right now is that there you have no risks. Right here we've got lots of risks, which means we're playing with a very dangerous thing that we call the damn it, I'll find it. I'll find this. This is what we call the risk management structure. This is what we call a Gaussian, a Gauss curve. Okay, and generally the Gauss curve means that as long as we remain into the usual standard deviations, everything is under control. And this is where you're making profits with automated systems, because automated systems are there to predict what's about to come. But as I said, it's chaos theory. So this is where you make the gains, because you can you try to predict things, and they behave the way they should. So you're making gains. And where the problem is that when you play this, and all the asset managers are using that Gaussian structure to manage the risks, me included, the fact is that at some point in time, something is unexpected, and we're getting to what we call the 90th percentile, in which nothing is predictable. It means when you have been piling too many risks that you just don't know where the danger will hit you. It's unpredictable, and it means that all the Gaussian principles are just going to fall apart, and all the systems will fail at once because something unexpected is going to show up. Piling too many risks, at some point it's going to show up, and whenever it will show up, all the Gaussian systems will just fail, which means all the algorithms who's been trading the trends will just brutally take huge losses and piling people into dangerous areas and dangerous behaviors. Because when you're taking heavy losses, you're always having emotions aside, and emotions means the market will trade emotionally, and generally it reminds me to trade bearish instead of bullish, even if the entire consensus is bullish. So, as always, I know I'm kind of trendy, so I know that I don't have to put leverage, but all I know is that the next profit is not to be made to the bullish side, but to the bear side, and it just requires a few more months of patience and respecting the strategy. So I'm cutting some slacks to the bulls, so they can have the S&P 500 market top. But if they're having it, I know the recession is down the road, and it's no longer going to be a corrective trade, but a recession kind of trade, in which the target will be returning down there. And it's going to be a two-option scenario. Basically, the scenario will be, okay, we're doing it fine, or something wrong happens, and we get there. Not in a straight line. It's going to be first line in here, just breaking the first support, kind of pull back, then slowly grinding down in here. Slowly grinding down, fastly grinding down because of the credit bubble burst. And then we're going to slowing the pace, and probably going to have to find our way to the next cycle afterwards. Okay. With subways, of course, it's not going to go into a straight line like that, but probably going to have wave 1, wave 2, and then wave 3. You know the drill. The deal, sorry. So that's how it goes. I mean, economic cycles just always put themselves ahead the same way. So I expect the next economic cycle to be a pretty great one, as we're going to have much more inflation as usual, but this is how I see things. If you want to buy, this is where you want to buy. Obviously not there. It's going to take years before you get to the actual entry price. And believe me, wave 1s are not that big. And generally, this is how it plays out. Wave 3, very long. Wave 4 as well, to get to a 6 to 10 years economic cycle. So this is what you can expect into the next economic cycle. Pretty much what we've been done. Just replicating the always the same structure. Okay? So if things still remain great, I see that we can make just a 40% drop, not that big of a deal, short-term recession, and then we're getting pretty nice investment timing in there to buy at the lows for a next economic cycle. So this is where you want to make the buy and holds regarding the shares, just like as you would have done with the cryptocurrencies. I told you not to buy the fucking high prices, just to sell those to make money in order to buy at the lows. That's how you do it. That's how you make the buy and hold. You're not buying a falling market. You're not buying a market top either. You're buying the lows. That's how you do things with a rational investment strategy. Okay, so that's how it is. That's what I wait for. Option number 2 will create a speculative nasty bubble. Even same thing, we just copy what we've done in 2017 with a much nastier pricing. I don't know how we can go. It's just, as I said, creativity is the only limit, but the price for this is that if we do this, we're going to have the exact opposite at the lows, which means we'll have a deeper crack, and which means we're going to lose probably 60 to 80%. Because if we're having speculative crash on top of credit bubble crashing, you can expect 60 to 80% drop in valuations, and this is even worse than what you expect. Okay, so I would pretty much like to avoid this for the economy, because I think we can survive a 40% drop on pricings. I don't think we can survive a minus 60 to 80% drop in equity pricings. Okay, I think the economy can take it as a slight recession, a tiny recession, probably 1 to 2 years at best, nothing more than that. And we can even clear this for 2020. I mean, eventually it can be just a fast recession, just flushing the credit bubble out and getting into a pretty rewarding economic cycle afterwards, with the blockchain helping to review things and making the revolution we've been talking about. So that's possible. I'm okay to buy that revolution, but I want to buy at low prices, nothing close to buying the highs. So you do as you please. Once again, I'm just there to make you assessing the right risks, just not making the timing. Making the timing is just a set for stupid traders, dream catchers, or things like that. And nothing close to this. I'm just selling you pure reality. The reality is that no matter how long this will take, the next move is bearish, and you can think it however you want. Just don't buy stocks. That will be the worst choice ever. Don't get into the bubble. It's nearly the end of it. Consider the bubble as being some kind of a pyramid scheme. So do you really want to be the last one to buy before the pyramid just collapses? You don't. So let the stupid guys buy Amazon or whatever at stupid pricing. Just let them buy the shit. Watch those. Laugh at them when they tell you that they're making huge gains, and wait for the collapse to take their gains. It's how it is. Lots of you guys have been thinking I was stupid to sell the bitcoins back then. Even if I started at 8,000s, you were right to the 20,000s, but I took more money than you done. So this is how it is. No matter how much, no matter how long, I'll always take more money than you will. Because I'm a professional, and this is how professionals do. The money tends to go to those who lack of patience, to those who have the patience. So trade smart, and we're going to terminate that show in here. I hope you've learned an important lesson today. When you have long-term traders fighting short-term traders, you don't want to be into the short-term side. Or you can do it, but be aware that you shouldn't your trade shouldn't last more than a few candles. Okay, so it's really play it, take it, don't hold it. If you're trying to make the hold scenario just following the short-term trends, you're going to be wrong-footed, obviously, at some point. And guys like me will be there to take your money. So bye, guys, and see you next week.